Hi, and welcome to our first ever Facebook Live event from beautiful Ion Retirement Studies. We are going to be discussing the One Big Beautiful Bill Act. We'll also refer to that as OB3 tonight, and how it impacts you. I'm your moderator, Lauren Dietz, and tonight's presenter is our lead tax advisor, Joshua Cicora. Tonight, Joshua is going to discuss the highlights of OB3, and then we'll open the floor up for some of your questions afterwards. Please feel free to start sending those in now, and we'll try to address them as time allows. This bill is known by a variety of names, such as the One Big Beautiful Bill Act or the 2025 Tax Act. For the purpose of this webinar, we'll just refer to it as OB3. We ask that you please keep the comments respectful and please refrain from any overt political commentary. Without further ado, I'll let Josh take it away.
Hey, good evening. Welcome in, everyone. So as Lauren kind of talked about, we're going to start talking through the One Big Beautiful Bill Act and how it impacts regular individuals. As you mentioned, we're going to call it the OB3, and I'm sure I'm going to stumble over that a number of times. So without much further ado, let's get started. So the Tax Act starts going into effect over a variety of dates. And as we go through these dates, things are going to change from year to year. So currently, we are under the Tax Cuts and Jobs Act. That's the tax law we've had since 2018. That law expires here at the end of the year, which is why they had to pass the OB3 before we got there. The new law has a couple different important effective dates for tax years beginning after the end of last year. So that means starting in this year that we're in. A number of things are going to start changing. So the standard deduction is going to jump up. It's going to be about $16,000 for individuals, about $32,000 for married couples. For the child tax credit, it gets moved up by about 10%, and then there'll be further adjustments going forward. We're going to talk about this here in more detail here in a few minutes, but there's a new TIPS deduction. There's going to be a new auto interest deduction. There's going to be a new deduction for seniors. More details on that coming. Starting in this year, there will no longer be a credit for electric vehicle purchases. You have to have that done by September 30th of this year in order for that credit to go into effect. If you buy it October 1st, unfortunately, you're out of luck. And that's why planning on these tax issues is always so important. For people who are maybe selling things online or using things like PayPal, Venmo to cost share or to reimburse family members or things like that, there has long been a threat of getting a 1099-K in the mail. And what does that even mean? And what does that do to my taxes? Well, going forward, that limit goes back to where it had been of either $20,000 of transactions or $200 of transactions. So that means unless you're running some kind of a online retailer, you're not going to have this be an issue for you any longer. And then there'll be an increased deduction for state and local taxes should you choose to itemize on your return. Starting with, years after this year, so starting with 2026, we're going to see the income dollars covered by the different tax brackets go wider so that more people will fit into the lower tax brackets than previously. Starting again next year in 2026, the other dependents credit, which is a $500 credit if you have dependents over the age of 16 that meet certain income guidelines, that will be made permanent. So that will keep going on as forward. This next one's actually kind of exciting, I think, for the teachers that might be watching. For educators, you can now start deducting as an itemized deduction classroom expenses that exceed that $300 you've been able to deduct for a number of years now. So that'll create some new opportunities for teachers to get some of their classroom supplies that they have to pay for out of pocket subsidized through their taxes. On the other hand, a not so great impact of the law will be that if you do charitable giving, the first 0.5% of your AGI won't count anymore of your charitable deductions. So that's going to require some different planning there. For if you're worried about estate planning, that estate exemption for the estate taxes, that's the asset tax that goes on your assets after you pass away to your beneficiaries. That gets made permanent at $15 million for individuals, 30 for married couples. So a lot of people won't have to worry about that component of their estate plan because it's being made permanent. But we're going to come and talk about what permanent means here in just a minute. If you are making energy improvements to your home, whether that's like windows, energy efficient heating or ventilation cooling systems, that credit's going to go away in 26. So if you're looking at those kind of improvements, those probably should be happening now if you're looking to take on that, to look at that tax credit. Now, jumping forward, the new law also has some expirations tied to it. Starting in 2028, we're going to see that tips deduction we talked about a little bit, that overtime deduction, the auto interest deduction, the senior deduction. Those go all away after 2028. So those are some temporary provisions in this law that people should be aware of, because those are going to be changing. And then starting in 2029, we're going to see that state and local tax cap on your itemized deductions drop back down to $10,000. So if that's something you're excited about getting to deduct, then that creates some planning opportunities to make sure you're going to continue getting that deduction going forward. So now what's next? Let's talk a little bit more about that tips deduction. That deduction has a cap to it. Sorry, bear with me one moment here. So the deduction has a cap, $25,000 for all filing statuses. So that means whether you're single, married, filing jointly, whatever, that deduction has a $25,000 cap to it. There's an income limit to it. If in the household there's more than $150,000 of income, then that deduction is going to be limited. So that'll be situations where you maybe have one spouse who has a higher wage, and then the other spouse who's receiving the tips may not be able to deduct all those tips because of the other spouse's higher income. That creates a planning opportunity. In order to take the deduction, you have to be in one of these certain occupations. That occupation will actually be listed on your W-2, believe it or not, and it has to match one of the occupations as defined by the IRS. The IRS is actually, interestingly, has already released some guidance on this. And while some of these occupations are things you would expect to see, like waiters, busboys, bartenders, people you often tip, there's also some interesting ones in there. For example, roofers can deduct any tips they may receive, or HVAC installers can also deduct any tips they may receive. So we'll look forward to see what additional guidance comes out of the IRS to further narrow down what these occupations are. Also, the actual amount that you can deduct as a tip will also be disclosed on your W-2. So as tax preparers, we're relying on the employers to tell us what the actual deductible amount of tips will be. Next up, this overtime deduction. I know lots of people are excited about this one. This is another deduction that has a cap to it, up to $12,500 for single filers, $25,000 for joint filers. Now what this means is that they will be, if you receive overtime, you will be able to deduct that so long as it's paid in accordance with the Fair Labor Standards Act, only the premium portion. To say that differently, we often talk about overtime being time and a half. The time piece of that will still be taxable. It's the and a half part that will create a deduction. There's income limits to this one as well. $150,000 for single filers, $300,000 of income, or $300,000 of income for joint filers. As of right now, the IRS is telling us they're not updating W-2s for 2025. They'll update them for 2026. So what this reporting will look like is anybody's guess, and that's why the IRS tells us more guidance is set to come. But the key here to remember is that it's going to be the employers telling the tax preparers exactly how much of the tips, how much of the overtime is allowed to be deducted. Now remember, both the tips and this overtime deduction expire at the end of tax year 2028. Moving on, the auto loan interest deduction. This deduction also has a cap. It's $10,000 of interest paid on U.S. manufactured vehicles if they are purchased starting in 2025. The loan has to originate after December 31st of 24. It has to be for a new vehicle. Personal use only. That means if you're using it to Uber, to run Lyft or DoorDash, whatever, that wouldn't be eligible. The loan has to be on the vehicle. There's some specifications about what kind of vehicles are allowed. Generally, it's more by the weight than the type of vehicle. There'll be information on the vehicle sticker that tells us about if the vehicle will qualify. The key, though, is that the final assembly has to be in the United States. There's going to be some kind of documentation generated by the auto lender that you will need to include with your income tax information this year in order to claim that deduction. So that'd be something to keep an eye on in the mail for when that documentation comes, or you'll get an email or something like that. But in order to take that deduction, we'll have to have that documentation. Again, this is another one where the IRS says more guidance is to come. So we're still playing this waiting game on this deduction as well. Moving forward, my apologies there, we're the senior deduction. Now this is something new. For individuals who are over 65, they qualify for a $6,000 deduction. Now it's per person. So if you're a joint filer, you're both 65 or older, then that'll be $12,000 on the return. This is another one that has income limits to it. $75,000 for a single filer, $150,000 for a joint filer. Once you exceed those limits, like these other deductions we've talked about, the deduction starts to get reduced as you go over those income limits. Now, all of these deductions are in addition to whether you itemize your regular deductions or you just take the standard deductions as you always have previously. A key piece on this deduction, which is a bit different than any of the others we've talked about, is that if you're married, you have to file a joint return in order to claim this deduction. That's a little odd. I can't really explain it. That's just how tax laws come together. And again, this one, like all the others we've talked about, expires at the end of 2028. So again, it's a limited time planning opportunity. The key conclusions, things to take away from this quick run through here real quick, is that there are numerous items that are key to your income, meaning it's important to plan out your income before the close of the year so that you can understand how these different items will impact your tax return. A lot of these are a limited time opportunity. You only have the 4 tax years, 25 to 28, to take advantage of these. And if you miss the opportunity or you don't plan to take advantage of that opportunity, it's really gone forever. As you heard me say on each one of these issues, there are more updates to come from the IRS as they continue to develop the regulations necessary to enforce this new tax law. And now we're going to go ahead and open up the floor to questions, and let's send it back to Lauren.
All right. Thank you so much, Josh, for that presentation. Now that we have reviewed the highlights of the bill, let's get into some of the details that might be of interest to all of you. To get us there, let us turn the questions to you all that you've been sending in while Joshua has been running through the high-level components. Did have a couple of questions that had come in before the webinar that we wanted to touch on. The first question, Josh, is Social Security tax-free, or are there restrictions? What is the $6,000 about?
Yeah, that's a great question. One we've heard a number of times. So before they got into these the negotiations around the legislation, the goal was to try to make Social Security free of income taxes. As they got into it, they discovered, I'm going to say, or they realized that they can't use the budget reconciliation process to change how Social Security is taxed. So they had to go about it a little differently. The rules around how your Social Security is taxable or not are unchanged. So what they decided to do instead is say, well, the average, normal, traditional age of someone turning on Social Security is 65. So then let's have a new deduction to go into effect, the $6,000 per person, and use that to try to mitigate or reduce the component of Social Security that's taxable. And from the statistics produced by Social Security, that will be somewhat effective by increasing about 20% of the number of people receiving Social Security benefits that will now not be paying tax on them because the income is absorbed by this new deduction.
Okay, all right. Another question that we had received, what provisions of the OB3 are permanent versus temporary? I know you did talk about that, but maybe we could discuss that a little bit more. And what is the duration of the temporary changes?
Yeah, so the items that are temporary are going to run from tax years 2025, that's the year we're in, through tax year 2028. So that gives you 4 tax years. Bear with me here a moment. I don't have all these details quite committed to memory yet because it's still a new tax law.
I can't imagine why.
I know, how silly of me, right? So we talked about the tips deduction. That expires at the end of 2028.
Right.
The overtime deduction also expires at the end of 28. This new senior deduction, guess what?
2028?
28. Auto loan interest, let's see if you can go 4 for 4.
28?
28. What's going to be, oh, I'm sorry, one more. The deduction limit for state and local taxes, deducting those.
Right.
When does?
2028?
No, 2029.
Oh.
Yep, pulled a fast one on you. The permanent pieces is going to be most of everything else we've talked about. That's the child tax credits, the other dependent credit. It will also be the increased standard deduction, the decreased income tax rates that we saw under the Tax Cuts and Jobs Act. I'm going to throw a caveat out there. We say permanent. What does permanent mean? Forever, right?
Forever. Yeah.
You know, you get a permanent marker, you make a mark, it stays there forever. Permanentness in taxes, though, just means until somebody else decides to change it. So it could be 2029, all of these things change. We don't know. Congress can change any of these things anytime they have the will to do that. And so it's a safe bet through the end of your tax year 2028, everything will stay as planned.
But it could potentially change sooner.
You know, we often talk about elections having consequences. And what that means in a tax situation is as you cycle out these groups of elected officials, priorities can change, policies can change. We see that happening time and time again on the tax side. What one group thinks is important is different than the other group. And as the groups cycle through, they can then change the policies as they see fit.
Sure. Okay. Our third question. This is a really long one. What senior deduction?
The senior deduction is a new deduction for seniors. I know some people don't like that term, seniors who are over the age of 65. That deduction applies, like I just talked about, it was really there to try to offset the taxable Social Security.
But they don't have to be on Social Security, right?
That's right where I was headed. They don't have to be on Social Security. They could still be fully employed, planning on being employed for the next 27 years, not even thinking about Social Security till they turn 70. And so long as they meet the income guidelines, they will still get that new senior deduction.
All right. Well, our next question is, what happens to these new deductions if I itemize my deductions?
Most of these things I've talked about are completely separate from your standard versus itemized deduction. So that means going into this next filing season, I think we're going to have 6 different deductions to talk about. We'll have the standard versus itemized. We'll have the qualified business income deduction, which we've had ever since we've had the Tax Cuts and Jobs Act. We have the senior deduction, the tips deduction, the overtime deduction, the auto interest deduction.
There's going to be more line items for deductions on the 1040 than there's going to be for income.
Do you remember when they talked about having a postcard tax return?
Yeah, well, that was
That
cute.
ain't happening.
That was cute.
Yeah. Definitely not after this, that's for sure.
Right. Our next question is, I am supposed to meet with you and my financial advisor in a couple of weeks to discuss a tax plan for the year. Will these new tax changes be incorporated into that discussion?
Yeah, that's actually one of the reasons why the law was passed in July. We're now just having this webinar today is I've spent the last month or so incorporating these different provisions into the tax plan we discussed at that meeting. For those of you who haven't had the joy of sitting through one of those, that's where I sit down with your financial advisor, who usually is actually paying for that conversation, and we talk about how your year is going to be impacted by the tax laws in effect for this year. And so we sit down, we kind of talk through what your income is going to look like, and then we start talking about what opportunities might exist to do something intentional in that tax year. Before it closes out, we talk about whatever unintended consequences might exist for doing something or not doing something. And then we kind of talk about what your tax return is going to look like. And so in that conversation, we're going to talk about things like the senior deduction. Well, if you're working the tips, the overtime deductions, so that if we do something, are those deductions still being taken advantage of? Are they being reduced because of whatever we're going to do? Are you okay with that or not? So yes, we're going to talk about that, and we're going to talk about it in some detail.
All right. Well, I'm sure glad that they did pass this already because I've already started my tax planning appointments for the year, and it's been helpful to have all of those updates incorporated.
As have I, and in years past, they have done these kind of things like in, December or January, retroactive to the beginning of the prior year. And by that point, we can't do anything to try to take advantage of it. That's the whole point of having these tax planning conversations, is trying to drive an intentional change in your tax year before the year closes out. Well, if they change the rules of the game after everything's said and done, we're kind of stuck.
Right. Okay, we've got another question that just came in. Is the $150,000 income limit for the senior deduction based on AGI?
Yes.
Okay.
Yes, that actually has been a very common question, even in the professional sessions I've been involved with, because if it's not in your adjusted gross income, it's in your taxable income, and then the deductions in your taxable income, it just becomes a circular calculation.
Right.
And everybody goes crazy. So yeah, it's in your adjusted gross income before, once all those adjustment things have been ran through.
Okay. Got another live question. Any change to any of the capital gains rates?
Shockingly, no.
I was kind of surprised by that as well.
I was as well. I don't really know. I don't really know why. Nobody ever really talked about it. It's still 0, 15, or 20, whichever is less than your regular, your ordinary tax rate. So to kind of throw some numbers to it, let's say your income is where you're having a 24% regular tax rate. Your long-term capital gains rate is 15%. Same 12-month holding period. Same old, same old.
And it'll increase a little bit due to inflation as far as what counts in each of those brackets.
Yeah, those inflation adjustments move it every year.
Okay.
So long as there's inflation adjustments. Some years there aren't inflation adjustments.
That's true.
I don't think this will be one of those years.
I don't think so either. All right, got another live question. You mentioned state and local taxes deduction being eliminated in 2029 with the standard deduction, or does it have to be itemized?
The state and local taxes, state and local taxes deduction is one component of your itemized deductions. And so in 2029, it will go from the $40,000 plus cap it'll be at that point, and it will drop to the $10,000 cap that we've had up to this point under the Tax Cuts and Jobs Act. When that goes away, it will impact just your deductions if you itemize. If you take the standard deduction, you will see no impact whatsoever.
All right. What is the phase out rate for the $60,000 if you are over $150,000? Or I'm sorry, not $60,000, $6,000 for the senior deduction if you're over that $150,000 in adjusted gross income?
Yeah, that's a great question. It's 1% per $1,000 over the limit. So that means that it fully phases out after $100,000 after that phase out starts. Or some quick back of the envelope math that makes it easy is $60 for every 1,000 that it goes over.
Okay, that makes the math fairly easy.
Yep.
Okay, another question that we had received was, well, never mind. That was one that we had already gotten. Let me take a look here. I believe we've got another one coming in. Do I still have to itemize my deductions in order to take advantage of charitable contributions?
For this year, in general, yes. I say in general because there are still other ways that you can deduct your charitable giving. So for example, if you're over 70 and a half right now, you should be working with your financial advisor to make sure that they are helping you with your charitable giving so that you can still take advantage of it on your tax return. Starting next year, however, there will be a new deduction above the line, which means it's not an itemized deduction, where you can deduct up to $1,000 of your charitable giving right on the face of the return and then take the standard deduction.
All right, all right. Another person has asked, when will I see the impact of the new tax law?
Not today. Yeah, so they haven't issued like updated withholdings tables. They're not updating a lot of the things we're using to drive like your withholdings this year. So if you are going to be picking up the tips or the overtime deductions, you won't see that till your taxes are figured in the spring. We had kind of hoped that they would redo those tables so that people would see less withholdings, but they said, we're not going to do that. We're just going to forget about it and move on to dealing with 2026.
So everybody's getting refunds?
I would suspect that people see either smaller balances due or bigger refunds going into the filing season for 2025. The spring coming up, just because these deductions, they're going to finally get to see the benefit of, instead of having little bits of benefit during the course of the year.
Right. Okay, another one. Let's see. Can tips be reported on a 1099?
Tips cannot be reported on a 1099 because
Can you
in
tell
order.
me more about that?
I sure can. So tips is either you're a employee and so you're getting a W-2, and so it's going to be on the employer to put on the W-2 what your tips are. If you are not working for a employer, you're self-employed, then it's going to be on you to report those tips.
Okay.
And I'm sure we'll see more details about how that's going to work.
I hope so.
Because I can't imagine that won't get abused. So I'm sure the IRS will have something that comes out that helps us figure out how that's exactly going to
And
work.
I'm sure it's going to be really long-winded and really easy to understand.
But you know what's
because that's
great?
how the IRS is.
That is how the IRS is. But you know what's great?
What?
Wouldn't it be wonderful if the people had like a radio show they could listen to, or like a podcast or a YouTube show they could watch to pick up these changes as they come out?
I think I might know somebody.
Who would you know?
I think maybe Ion Retirement.
Or Retire Hour. Yeah. And people can find those shows over at retirementhelp.com.
That is exactly right.
To help stay up to date with these things as we get these additional guidance and details.
Yeah, awesome. Okay, another question is, you mentioned that the QBI, which is Qualified Business Income Deduction, was made permanent. Is it still at the 20% rate?
Still at 20% rate. I suspect whoever asked this question has been paying attention, because in the Senate version of the bill, they upped it to 23%. And then, so the Senate passed that, sent it back to the House to reconcile out these differences, and that piece actually got dropped out and got left at the 20%. But if you're somebody who has a small business, so that means it's something you're just kind of doing on your own that gets reported on your personal return, you're involved in a partnership, an S corporation, or you're invested in a company or you're invested in a way to get what's called 199A dividends. That deduction's been made permanent, so you will continue to see those benefits going forward. But remember, we talked about what permanent meant. Permanent, that's right.
All right. Somebody else asked to please recap the energy deductions for windows.
Yeah, so the windows, I believe it's a $200 credit per window. There's a cap on how much you can get overall. Those all have to be installed and done by the end of the year in order to get that credit.
So that won't be one that's got to be done by the end of September, like the energy credit for vehicles,
That's
right?
right. Vehicles
they've got till the end of the year.
That's right.
Okay.
End of year 2025. So that just means that if that's something you're looking at doing,
Better get those
you
windows.
better get moving, because I can tell you, contractors take a little bit to get that stuff done.
And it's going to be based on the installation date, not when you
You know,
decided to call them up and.
that's right. So if
and
you
ask
call
for
them in December 15th, I do not think you'll be getting that deduction or that
Right.
credit.
Okay, another question is, so then I will have to pay tax on my Social Security benefits? The
Yeah.
short answer,
The
maybe?
short answer is yes, as you've been doing previously. The maybe part of that is that if you do qualify for the senior deduction, do remember that people can sign up for Social Security as early as 62. So there's a window 62 to 65 where you're getting Social Security but don't qualify for the deduction. But if you're collecting Social Security and you're over 65, you'll get the $6,000 deduction per person, which should offset some piece of the taxable Social Security. I was actually just reading today, interestingly enough, that there's been legislation introduced in both the House and the Senate to make all Social Security benefits free of tax by increasing how much of the wage earner is subject to payroll taxes.
Oh, okay.
Yeah. So, I mean, we'll see
mean, that,
this is why we talk about more guidance is coming, because there's always more legislation in the works. That's why it's important to be working with somebody during the course of the year to making sure you have the best updated information the guidance as it comes out, and then taking action to get these benefits for yourself.
Yeah, absolutely. Oh, here's a good one. I like this one. So if you take your IRA qualified charitable distribution or QCD, can you take the up to $1,000 of charitable deduction in 2026?
Yeah, sort of. So what you take as a QCD or qualified charitable distribution gets deducted above where that charitable deduction will go. So you can take both, just not on the same dollar. So if you give $50,000 out of your IRA to a charity, that's your qualified charitable distribution. That goes in one place. And then you give $500 cash, at church, then that goes in a different place. So you can take both, just not on the same dollar.
You can't double dip.
IRS
doesn't like that.
There are very few places where you can double dip.
Right. And that's probably not ever going to be one of them.
That's right.
All right. Let's see. Got another one. I heard something about an above the line charitable donation of $2,000 for non-itemized. Is that true?
I will be honest, since that goes into effect next year, I'm not as 100% on that one. Bear with me a moment here. It's $1,000 on a single return, $2,000 on a joint return.
Okay. So yeah.
Yeah.
All right. Can I still get a tax credit for buying an electric vehicle?
Only if you complete the purchase by the end of this month.
So you better get to shopping.
And point of reference for anybody who might be listening to the replay, end of this month being September 30th of 2025.
Correct. Yeah, that's like 3 weeks.
Better get shopping.
Yes, better get shopping. As far as on that same note of electric vehicle and energy efficient improvements, they also asked, what about energy efficient home improvements?
End of the year.
So we're still in a time crunch, but not as bad of a time crunch.
I would say it's worse of a time crunch because, as you know, working with these home improvement contractors, it takes a while for them to get it scheduled, to get materials ordered. Yeah. And so, honestly, if you go talk to somebody now, it could well be too late.
I was going to say, I know you're in the middle of it. I was in the middle of it. It took about 4 months for me to get a new bathtub, which I love.
With those electric vehicles, they're probably already on the lots.
Yeah.
So
hopefully.
That's right. Yeah.
All right. Let's see. That looks like that was probably, I think that might have been our last question that we've got, unless there's anything else.
Hey, I'm just excited people sent questions in.
Hey, no, honestly, those were some really, really good questions. Right. All right. So looks like we've reached the end of those questions. Our mission at Market Tax Services is to keep you informed and confident about the future of taxes in our country. We're always here to answer any questions you might have. We look forward to any chance to provide educational resources for our clients and the community. We thank you again for tuning in, and we will certainly keep you in the loop about future live events. Thank you so much.